Hello everyone, this is Brian Rezny, President of Rezny Wealth Management and of course the host of the Rezny Wealth Report. We've got a great show for you tonight as always, and make sure if you have questions about your portfolio, whether it's about a stock, a bond, a mutual fund, maybe an ETF, maybe you're concerned about your allocation, maybe you bought or were sold too many annuities and you're concerned about who you're working with and if they're working in your legal best interest, call us right now. We're going to start lining up phone calls. By the way, when you do call that number at the bottom of the screen, 239-417-4711, it's easy. Call, talk to a studio producer. They'll take your question and they'll relay it to me. So you don't have to actually go on TV. Nothing to be nervous about. But we're going to talk a lot about the economy and the investment markets. As a lot of you probably by now have heard, believe it or not, but our government, the adults have entered the room, and there's finally, the negotiations have ended, and there's a deal for the debt ceiling. This has gone on for a while, and I've repeatedly, not only in my TV and radio shows, but I've tried to help you, the investor, understand that this whole debate about the debt ceiling, all these things that go on in government really are a moot point for most investors. In fact, you should never factor this noise or news, as we call it, into your investment decisions because it's only going to screw you up as an investor, and it often will cost you money and return on your portfolio. At Rezny Wealth Management, we're a fee-only money management firm. I can tell you from my 27 years in the investment business, we do not put 1 ounce of our investment strategy influence on what goes on the daily news channel. We often call a lot of these shows talking heads because all they want to do is hype things that basically make investors nervous and make you, the investor, make poor decisions with your portfolio. So at my firm, and for the last 27 years, we've never put any of this short-term rhetoric from our government or any other short-term event into play in our investment decisions. And we feel that's definitely benefited our client. I would suggest every one of our listeners today, if you get nervous about things that go on in the news, turn that TV show off because most of that stuff that you hear has no impact on the next week or next month or the next 3 months on your portfolio. These are all short-term news items. You know, one of the things that we'd like to talk about on my TV show are your questions about your investment portfolio. So again, I know we're getting some calls now. We're going to line up some questions about your portfolios, your questions about specific investments. Again, don't be afraid to call the number on the bottom of the screen. We want to help you out. One of the things that I wanted to discuss today in a little bit more detail, only because the majority, well over 50% of the calls that we receive not only on our TV show, but on my radio show, over 50% are from investors who were sold annuities and didn't know what they were buying. These investors bought things from people they thought they could trust, from the nice salesperson, but unfortunately what they soon realized a year or two into these annuities, it's not what that person sold them on, and at the end of the day, what do? The number one disgruntled call that we get on my TV and radio show, again, is about people who are misled and sold annuities. If you've watched my show for any length of time, you know that my firm and myself feel that annuities in general are toxic investments for your retirement. In fact, why annuities are dangerous to your wealth and retirement, I think at the end of the day, investors need to understand the details of annuities and how they really work and how they rob the return of your portfolio and actually harm your return. Now, the one thing that annuities are sold upon is you can get potentially lifetime income. What the problem with most of these annuities, there's no inflation protection, and often the money that you get monthly is only the return of your own money. And because the expenses on most of these annuities are so high that it actually robs you of any real return, they have often zero inflation impact, meaning they don't grow. So the money you get today, you're going to get the same paycheck 5, 10, and 15 years down the road. This is a mistake, and this is something people that are sold these products are never explained. A simple explanation of an annuity. A highly complex investment a very inferior investment sold by brokers whose interests are different than yours. The bottom line, annuities are complex. Why are they complex? So you don't understand what you're buying. Are the fees internally on these high? They sure are. Annuities, one of the most expensive and highly complex of all investment products manufactured by Wall Street and insurance companies. You have insane surrender penalties up to 22 years and up to 22% just to get your own money out. The average yearly internal cost of a lot of the annuities we've reviewed are between 3 and 5% or higher, and huge conflicts of interest from non-fiduciary advisors. The bottom line is this. Annuities are sold to typically unsuspecting or uneducated investors who didn't read that fine print. When somebody sells an annuity and earns a commission, they are not working in a fiduciary capacity. They're working under suitability. Under suitability, the interest of the client is not served, plain and simple. The bottom line, if you work with a fiduciary firm, most fee-only fiduciary firms like mine would never ever use a broker-sold annuity because these things are toxic on the return for you, the investor. Now, there are a few annuities out there that have no load, no back-end surrender, and very low expense ratios. The problem is, Mr. Annuity Salesman isn't going to show you those products because that doesn't suit him or her versus what's best for your money. If you have a question about an annuity, if you're having a question about any investment that you may own, call us in the studio right now. By the way, if you visit my website, reznywealth.com, we've got a free report available for all of our TV listeners today, how to avoid outliving your money during retirement. If you look at the bottom of your screen, you'll see our website at reznywealth.com. That report is free. We talk about real advisors and fake advisors. We talk about money management. We talk about how you can protect your retirement from the Wall Street casino. When you have a brokerage account, not an advisory account, you are responsible. I wanted to talk a little bit about that today also. I have done literally hundreds of public speaking engagements, not only in Southwest Florida, but around the country. I speak to a lot of groups, young and old, and one of the things that I try to educate all investors on is a false sense that your broker or advisor is actually watching your money. So if you take a look at your portfolio, if you work with any investment firm and on the bottom of their business card says securities offered through, or you've ever bought a variable annuity or a bunch of mutual funds in a brokerage account, you are responsible to manage your own money. I get questions all the time from investors. Brian, he or she never called me when the market started melting down. I didn't know when to sell. He told me he was going to watch my money. If you have a brokerage account, and I can tell you from experience, about 90% of the new clients that hire my firm to manage their wealth have a brokerage account, and they thought that the broker, who uses a fancy term of senior vice president or advisor, actually was watching and managing their money. So again, one of the things I want to do for all of our TV listeners today is make sure you find out, are you in a brokerage account or do you have an advisory account? There's a substantial difference. If you want to know more about the difference between a brokerage account, which is sales, or a advisory account, which is managed money, the best way to do it is visit my website. At the top of our homepage, you'll see the fiduciary versus suitability questionnaire. Go to Rezny Wealth right now. You can download that free fiduciary versus suitability questionnaire. It explains brokerage account, advisory account, fee only versus fee-based, which is a huge difference. And it'll also tell you how you can avoid conflicts from so-called advisors, annuity salespeople, and Wall Street shenanigans. Phil in Florida, what is my opinion about investing in the Iraqi dinar? Thank you. Phil, I would not buy that currency. Basically, the Iraqi dinar is the currency of Iraq. Don't touch it. I'm not exactly sure why you're looking at this, but this is basically a speculation game. If you think that you're going to make money buying a currency in Iraq, you might or you might not. But if you're trading currencies is about as risky as trading commodity futures. I would stay away from that unless you're an expert on currencies. I would firmly believe you'll probably take a lot of risk to probably not make any money at all. I think trading currencies is a high speculation game for somebody who wants to risk a lot of money. If that's not you, I would stay away from that currency, and I would stay away from currency trading altogether, because you're going to risk a lot more than probably what you put into that investment. Sam in Marco Island. My broker has me buying IPOs and other stocks routinely. My account hasn't done well, but he insists we should keep buying. Am I missing something? You're missing a lot. You're missing return, and you're missing money management. Your broker does not have an investment strategy. Your broker's interests are different than yours. You clearly have a brokerage account. Under a brokerage account, your broker does not have you in an advisory account, which is managed money. Your broker's interest is to keep selling and buying stocks for your portfolio to make him more money. The broker works under suitability. The broker's interests legally are to his firm and himself. Your broker is not working as a fiduciary money manager. You're getting bad advice and you're being sold down the river. Stop the relationship immediately. What I'm going to say is this: if you do not have an investment strategy in an advisory account and somebody actually managing your money, which is not your broker, it's not the advisor, it's not the financial planner, you need to make sure that you are under a registered investment advisory agreement that includes money management. Otherwise, you are probably in a brokerage account and you're being sold and churned. Also, IPOs. Stay away from IPOs. These are initial public offerings. IPOs are basically Wall Street's business, which is companies hire Wall Street to IPO or initial public offer their company. Kind of like Twitter and Facebook that everybody's heard about. When Wall Street basically contracts with Facebook to basically IPO their stock, Wall Street is not working for you, the investor. They're working for Facebook. They're trying to get Facebook the best deal, and they're trying to do the worst deal for you. Stay away from IPOs. I tell investors, if a company's good, wait a minimum of 1 year after a company IPOs so you can do better research before you ever buy one of these. You're not going to miss out on anything. In fact, the majority of IPOs end up losing a lot of money statistically the first 1 in 5 years. Stay away from IPOs. Wait a minimum of 1 year before you get any advice or before you buy one of these stocks that'll probably hurt your portfolio more than it's ever going to help it. Charles in Naples, Florida. Brian, I have the Wall Street pie you discussed. I work with a big Wall Street firm in Naples, and I told him per your show to sell gold in January of this year. He didn't. My pie has failed. Help. Charles, that is an excellent question or comment. I'm not sure if it's one or the other. We get a lot of questions on this. The bottom line is if you're working with most advisory firms, most brokers, most Wall Street companies, or the local guy at the investment department at the bank, they typically give everybody the pie. I call it the failed pie. This is the pie where they basically put you in, 10 or 15 investments, and they tell you we're diversifying you because they tell you, well, we're not sure what's exactly going to do well, so we're going to own some gold and some bonds and some stock. Traditionally, I can tell you from experience that what we normally see in the Wall Street pie is usually stock and bond-related investments. And it might be a 60-40 split or a 50-50 split. The bottom line is this. When you do what's called asset allocation or the pie, it's a failed approach. You own assets that may not be appropriate. In December 28th of 2012, and I'm glad you brought this up because I've talked about our firm selling gold since December 28th of 2012. We actually own gold through the GLD, it's an ETF, up until about December 20th of 2012. Based upon our proprietary investment strategy and the ranking of gold within other asset categories, it dropped down to the number 7 spot. We sold gold and we replaced it with IJH, which is the iShares Mid-Cap 400. Now, we did that at the beginning of the year. We still own IJH. We sold gold, and gold is still towards the bottom of our ranking system. By the way, since we sold gold, gold is down around 20+% year to date. IJH is almost up as much. So the bottom line is, if you own gold because your broker told you to keep hanging on the gold, and you had IJH, let's say that's up 20, and gold's down 20, guess what? You didn't make any money this year. Instead of basically owning what's relatively strong and running a strategy when to sell, you basically always own investments, regardless if they're good or they're bad. We're going to talk more about asset allocation after this short break. Our number's at the bottom of the screen. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. And we're back. Hopefully you're enjoying today's program. And again, if you have questions about your portfolio, our number is going to be at the bottom of the screen. We also have our website that we're going to post. If you'd like to visit our website, we do have offices in Naples and in Fort Myers. If you'd like to go to my website, reznywealth.com, and you're realizing you've used a firm that doesn't work in your legal best interest, maybe they've just sold you a bunch of garbage in your portfolio, maybe you haven't heard from that firm, maybe they loaded you up on a bunch of annuities and you're realizing that wasn't good for your portfolio, and you want to work with a firm who has a legal obligation to work in your best interest as a fee-only money management firm, call my firm for a consultation. We'll put that number on the screen also, or visit our website, reznywealth.com. You can sign up for a consultation there. You can also download our current report, How to Avoid Outliving Your Money During Retirement. We always like taking on new clients, and as I always tell our TV listeners, it doesn't hurt to talk and get a second opinion. Let's talk about asset allocation. How many of you have this that shows up on your brokerage statement? Asset allocation, 32 investments equals what? It's simple, a watered-down portfolio. We've done substantial back testing and studying and research at my firm, and it goes on every day. And it's not to sell people investments, because we don't sell investments. We manage portfolios. What I see hurt investors is, A, they don't have an investment strategy. They falsely believe their broker or their so-called advisor is actually watching and managing their money, which often is not the case. And if they do have their money invested, it's usually in 20 or 30 investments, and it's in this pie. You own a whole bunch of investments. Some are good, and a lot of them aren't that great. So the good ones get dragged down with the bad ones. I can tell you from managing money for a long time that generally speaking, if you have broad-based indexes and asset categories using ETFs, exchange-traded funds, I think investor usually can have about 5 asset categories in a portfolio. What our studies have shown, the more asset categories you have, all you do is drag down the returns of the good positions. It's kind of like owning gold this year and owning the stock market. Gold has dropped 20%, the stock market's up 20%. You put the two together, you've made zero. Has asset allocation really worked for your portfolio? Probably not. Keith in Cape Coral, Florida. You have been an advocate of small cap sector the majority of this year. Do you still like small and mid cap stocks and will continue to do well at the end of the year through 2014, and why? Keith, great question. First off, we're not an advocate of small and mid cap stocks. We do own two ETFs. One is IJR and one is IJH. The iShares Small Cap 600 and the Mid Cap 400 in the U.S. We've owned these for a good percentage of this year in 2013. We're not an advocate, but we own them because we rank all asset categories, not just the stock market in the U.S. and not just the bond market, and we don't do the failed Wall Street pie. We rank all asset categories. We typically own the 5 categories in our client portfolios, and there's varying degrees of that percentage based upon risk and goals for the client, but we usually never own more than 5 of those categories in our growth portfolio. We've owned those most of the year because they've been relatively stronger, meaning they've been outperforming most of the year all the other asset categories. As long as that continues through the rest of 2013, we're going to continue to own small and mid cap in the U.S., which, by the way, is beating large cap. Recently, Keith, we added emerging markets back into our portfolio because they have been relatively weak through most of this year, but as of about 6 weeks ago, they started to crest back up and started to get strong. So we bought them after they had the big fall, and they're starting to get relatively strong and outperforming the S&P 500. We firmly believe emerging markets will probably continue on that stance at least through the end of the month. If there are changes and we do make adjustments, we'll try and talk about that on the TV show. But one of the things that I stress to all of our TV listeners, our positions can't change at any time. At Rezny Wealth Management, we're not a buy and hold, set it and forget it firm. Risk management is an important part of how we manage our clients' portfolio, and if we need to sell any of our positions, we will do so to protect our clients' money based upon a strategy and a defined set of risk management rules. Larry in Fort Myers, my financial advisor is pushing us hard to buy an American Equity Bonus Gold Index annuity. He says it's the best annuity out there. What do you think? Larry, I'll tell you what I think. First off, your advisor is an annuity salesman using a fancy title to deceive you. That's number one. Number two, American Equity Gold is not the best annuity. There's no best annuity. In fact, most annuities are downright lousy, expensive, and insanely take away the returns from you, the investor. That person clearly wants to sell you the annuity that pays him the biggest commission, not what's best for your portfolio. I would fire that person immediately. You can call our office for a complimentary consultation. We'd be more than happy to sit down with you and show you exactly why that annuity is dangerous to your wealth, or better yet, go to my website, reznywealth.com. If you go to our Investor Resource tab, you can download for free our report, Why Annuities Are Dangerous to Your Wealth and Retirement. American Equity, that particular product, I believe, has over a 14-year surrender penalty to get your own money and a 14% surrender penalty. Also, it's tied as an equity index product or a hybrid annuity to a small percentage of maybe what the stock market makes with extremely high internal cost structure. We've done a lot of modeling on these hybrid or these equity index annuities these guys sell at this free steak dinner seminar. Bottom line, read the fine print. If you don't, you're going to be taken to the woodshed. The average equity index annuity that we've reviewed in-house, you can probably pretty much make maybe 1 to 3%. Most of these products, because of the internal cost structure, the cap rates, and because it doesn't include the dividend from the index they use, you're going to probably be lucky to make between 1 and 3% a year over a 10-year time frame. That's crazy, especially locking up your money. You could buy a 10-year treasury, make the same return, and have liquidity and have the full faith of the U.S. government behind you instead of the guarantee from an insurance company that could go insolvent and then you could lose all or some of your money. Don in Miami, Florida. My advisor's approach has been buy and hold mainly in American funds. I seldom hear from him. We lost 40% the last 2 recessions. We don't want a third. Don, I could pretty much guess probably which brokerage firm you're utilizing. First off, American funds. All your money's in American funds? Why is all your money in American funds? Well, I'll tell you why. Because the firm that you're working with has what's called a sales relationship and gets revenue sharing by selling American funds. In fact, they probably get more revenue sharing selling American funds than other funds, and that's why they sell you American funds. I can tell you American funds do not have the best mutual funds in all asset categories, not even close. Their expenses are high compared to ETFs. You would be much better off finding yourself a fee-only registered investment advisory firm like our firm. We'd be more than happy to talk to you. Your person you're working with, A, is not fee-only, is not a money manager. You're clearly not in an advisory agreement. You have a brokerage account, and you basically wrote it up and you wrote it down twice. Where's the risk management in play in this? This, unfortunately, hurts a lot of investors, not only you, but we hear about this all the time. When we have a new potential client come into one of our offices, whether it's Fort Myers or Naples, we often hear from people, Brian, I thought he was watching my money. Again, if you have a brokerage account, which is what about 90% of investors have, you are responsible. Unfortunately, I think what's happened is you didn't understand that. You could read more about brokerage and advisory. Go to my website, reznywealth.com. On the top of the homepage, click Fiduciary versus Suitability Questionnaire. It explains you have a suitability relationship, not a fiduciary, and that your money is not being managed. Once you read that free report, it'll kind of piece it all together for you. It's an easy read. We try to write it, as we call it, in 3rd grade English. But at the end of the day, read that report, and you'll realize the relationship you had all these years has been sales, brokerage, and non-management. Folks, I'm just about out of time. I appreciate all your calls and questions. Please, we're going to put at the bottom of the screen our website, reznywealth.com. Call us for a consultation or go to our website, reznywealth.com. You can sign up on our website to meet me, meet our firm at either one of our 2 locations in Southwest Florida. We'd love to help you rebuild your portfolio and work with you in your legal best interest as a true money manager and as a fiduciary. You would benefit from a consultation if you want to sleep well at night, you want less stress over your investments, and you want to enjoy retirement. I'll see you next week.